The Fed pumps the brakes. What now for real estate? Hey, this is Dave with the Bolduc Realty Group. Welcome to my weekly real estate market update. Today's June 16th. I want to take a minute to call out the North Haven class of 2023. They just graduated high school yesterday, and my son Michael is part of it. Congratulations, everybody. Michael, great job, son. Love you. Let's talk about some key market stats here. Active on the market today, 4,044 homes. That's a big deal. This is the first time since January 20th of this year that we've had more than 4,000 homes on the market in Connecticut. So really good news there. It's up 84 from last week. We had 422 new listings over the last 24 hours. There are 3,234 closings in May. So that's up from April. That's great. And based on May sales, we've got about 1.25 months of inventory on the shelf. So supply is still low and demand seems to be staying strong. So here's some key dates. It was a big week this last week. We started with CPI coming in line with expectations. And any report that comes in line with expectations for the markets and real estate and interest rates is always a good thing because there's no surprises, and surprises bring volatility. Following CPI, which is Consumer Price Index, we had PPI, which is the Producer Price Index. That came in lower than expected. So we had up 1.1% versus an expected up 1.5%. This is the lowest reading we've seen in about 2 years. And the good thing is the PPI is seen as a leading indicator for CPI. Producer is a leading indicator for consumer price. I believe this had a large impact on the decision that the Fed made to pause rate hikes and also their comments afterward. So PPI came in lower than expected, and it has been slowing down. That's great. The expectation is that slowdown is going to pass on to consumers. So I think what's happening right now is the Fed is waiting to see CPI slow down just like PPI has. We'll see how that plays out. Now, the wild card, in my opinion, is housing. Housing costs continue to rise. The Fed is calling for rents to slow down and actually to drop over the next several months. I don't see that happening, and here's why. Everyone still needs housing. So we're not going to see demand drop. And the current fiscal policy, very tight fiscal policy, is not encouraging new construction. It's not encouraging renovation of existing stock, things like that. So we're not going to see a massive explosion in supply, which could also drive prices down. I think inflation is going to be most entrenched in housing. Price appreciation for home sales and for rentals continues to climb, and I think it will continue until market conditions change such that new construction and renovation of existing stock becomes more cost effective. Do you agree with inflation staying in the housing market the longest, or do you think it's going to be somewhere else? Let me know down below in the comments. Talking about the primary mortgage market survey now. Average mortgage rates over the last week were pretty flat, 6.69 versus 6.71. That said, a lot of information came out after data was gathered for that weekly survey. So we had CPI and PPI that we've already talked about. The Fed paused the rate hikes for this month, and then they also projected 2 more rate hikes this year. The next one coming as soon as July. The data and the Fed decision to pause rate hikes were generally positive, but the real news was in what Chairman Powell said during the news conference after the rate hike was announced, or the pause in rate hikes. Powell said factors were in place for driving down inflation, but that we haven't had enough time to see the full effect of those factors. He also said, and this is the big takeaway in my opinion, that the Fed doesn't see rate cuts for a couple of years. Many have speculated, and the Fed has said several times, that rates will remain high for an extended period of time to combat inflation. It seems we now have a rough idea of what the general timeline is. In the short term, like I said, the Fed is signaling 2 more rate hikes, but also that there's no final decision made there. The decision is going to be made based on the economic data at the time. So We will continue to watch the jobs reports, the CPI and the PPI inflation reports, and consumer spending to try to get an idea of what we think the Fed is going to do. At the end of the day, as long as rates remain high, for sellers, they're going to be less likely to sell because they have to give up the lower interest rate loan on their current house and go to a much higher interest rate on their next house. For buyers, the cost of interest is going to continue to be a massive drain on their purchasing power. And as a result, there will be fewer homes sold. This is something that a lot of reports have been made on. Number of home sales is down dramatically. It's normal. That's to be expected based on these market conditions. The real problem is that means that the banks are getting less loans and realtors are doing less deals. That's why people are upset. The good news is homes are still selling. You just need to make sure that you're working with a real estate professional who knows what's going on in the market and can get deals done. That's what I have for today. Comments and questions are always welcome. Have a great weekend.